Hey everyone, welcome back to Corporate Decoder. Today, Top just filed an 8K about a new material agreement, and I am seeing a common pattern here of a company needing cash. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is selling a chunk of stock in a private deal. So let's decode what that really means for shareholders, especially considering their size. Alright, so this is a Form 8K, which is basically a report for significant events that happen between the regular quarterly and annual filings. For Toppoint Holdings Incorporated, or TOPP as it is traded on the stock market, this filing tells us about a recent deal they made. The main point here is that on May 19th of 2026, Toppoint Holdings Incorporated entered into a securities purchase agreement. Think of this as a contract to sell more of their company's stock. They agreed to sell 5 million shares of their common stock for 83 cents a share. This brings in a total of $4.15 million for the company before any costs. This is a pretty significant amount for a company with a market cap around $54 million, as we've seen in recent news. What is interesting here is how they set the price. They used the minimum price allowed by the NYSE American Stock Exchange rules on the day before the agreement. This suggests they might have been under pressure to get the deal done and didn't want to sell at a price that would trigger extra scrutiny or warnings from the exchange. And where is all this new money going? The company says it is for general corporate and working capital purposes. In simpler terms, they need the cash to keep the lights on, pay bills, maybe fund operations or invest in the business. This often indicates a company isn't generating enough cash from its core business to cover its expenses. This next part, item 3.02, tells us how they sold these shares. They did it without registering the sale with the Securities and Exchange Commission. Or CC, this is common for companies that need quick cash and sell to a select group of investors. They are relying on exemptions like Section 402 of the Securities Act, which is for private offerings to sophisticated investors. This means these shares weren't offered to the general public on the stock market initially, but rather to a specific group of buyers who met certain criteria, like being accredited investors or buying from outside the US in offshore transactions. The key takeaway is that these shares are not registered, so they can't just be freely sold to anyone in the US until they are registered, or another exemption is found. This is often why shares sold this way might carry some restrictions, or have less liquidity for the investors who bought them directly. Finally, under item 9.01, they list the exhibits included with this filing. The most important exhibit is the Securities Purchase Agreement itself, marked as Exhibit 10.1. This is the actual contract where all the details of the stock sale are laid out. There is also a cover page interactive data file, which is standard for enhanced financial reporting. Now, looking at this deal in the context of the company, Toppoint Holdings Incorporated is in the trucking industry. They recently reported a flat first quarter loss despite an 8% revenue increase. This means that while they are bringing in more money from their trucking services, their costs are increasing at a similar or faster rate, leading to no improvement in their overall profit or loss. This private placement is a classic move for a company that needs cash. They're essentially selling more ownership in the company to get funds, rather than necessarily signaling strong operational growth or profitability. When a company sells shares at a price like 83 cents, especially when it is near the minimum allowed price, it suggests they might be facing financial pressure. Historically, companies that have to resort to private placements for operating cash, especially smaller ones, can face challenges. It is a way to survive, but it often means dilution for existing shareholders, as the pie is now split into more pieces. For example, we've seen companies that are heavily reliant on these types of cash infusions struggle to recover. A $4.15 million infusion is substantial for TOPP, but it is crucial to see if this cash allows them to generate actual profits or just temporarily bridge a gap. My biggest concern is whether this capital injection will be enough to turn the business around or if it is just kicking the can down the road. The fact that they're using it for general corporate and working capital purposes is a common phrase, but it often signals a need for basic operational funding rather than strategic growth investment. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like this video, and subscribe for more, plus join our community in the Discord linked below.